For more on the president's comments about possibly waiting until after the 2020 election to strike a trade deal with China, we're joined by Erik Knutzen. He is, are we pronouncing it okay today?
We are,
Let's do. Knutzen, multi-asset chief investment officer at Neuberger Berman. Why have it if you don't?
You got to use it.
We say that all the time. Be proud, say it loud, say it proud. You changing anything based on the latest nuances to the deal? What we're hearing from the president?
No, our expectation was that if there was a deal, it was going to be a skinny or light deal. It was probably going to disappoint relative to what was priced into markets, especially this latest run-up in equities, and that in 2020 we're going to have to look for other drivers of positive market developments. We need to see a handoff from central banks to fiscal authorities. We need to see businesses start to invest instead of just relying on the consumer to drive the economy.
Right. Do we need a China resolution for the economy and the stock market to continue to do well?
I think most of the potential damage around trade conflict is already priced in. Has
it been significant, Erik?
Damage associated with trade?
Yeah.
Some to the U.S., some modest hit on GDP, maybe 25 to 50 basis points negative on the U.S., higher for China, 50 to 100 basis points of negative GDP impact. Biggest damage was collateral damage on Europe, other major exporters, Japan, South Korea. U.S. and China have largely reconfigured and restructured to prepare for and be positioned for kind of an ongoing lack of trade peace, let's say, as opposed to conflict.
What about this next wave of tariffs? Is it linear? So is it another 25, 50 basis points here in the U.S. and 50 to 100 in China, I think you said?
So you look at the incentives for the current administration. They do not have an incentive to add another tariff on December 15th to create more volatility. We think of this administration as having a volatility budget associated with trade conflict. They can spend some of it, but they're not going to want to spend a lot of it in creating another negative December like we saw last year. The big risk, we would say, would be their escalation with the Chinese, which we don't think is likely. Neither side is strongly incented to create more volatility here around trade, although we don't see strong incentives for some kind of grand bargain, maybe some small agreements, maybe now later than what we were initially anticipating. The big concern would be a pivot to Europe or broadening the trade conflict, and there are some rumblings of that now overnight.
So you gave the counterfactual for the GDP. If there hadn't been a trade war, what do you think it would be for the stock market? What do you think it would be for the unemployment rate? That's what I'm trying to figure out. What would it be for wage gains? So would the market be up twice as much? Would unemployment be 2%? Would wage gains be 7%? I mean, some things are at historically low levels, like unemployment. Other things are at historic highs, like the market. So are you telling me this has been a really negative thing for the United States, the trade war?
Well, certainly if you translate those numbers into earnings and apply a current valuation on the stock market, then yes, the stock market could be somewhat higher based on earnings growth this year, which are going to be flat to slightly up.
Could be 30%. It could be by the end of December. We could be up 30%.
But what if earnings growth this year were 10%,
not multiple might contract
5 or 6%?
I don't know. It's hard to put. It's just hard to imagine that.
Exactly. Yeah.
I don't.
Certainly.
Also, I wonder what part of that is low interest rates, right? If interest rates
we've known
were higher,
that. Yeah, we've had that for how long? 15 years.
15 years. But if the economy was slightly better,
but it looks like they're not going up anytime soon.
Yeah. Right.
I think what Jim Cramer made a point yesterday I thought was really interesting. Just the idea that if you think prices are going to go up from here just because of multiple expansion, just because people are willing to pay more for the same thing, maybe you should think again on some of those issues. I think he's a little concerned just for the short term, at least.
Well, indeed, and that's why we are cautious right now in equities. We're neutral U.S. stocks. We're starting to look for opportunities overseas. We pulled back from non-U.S. stocks at the end of the summer. A thesis where you're owning stocks because you expect multiples to expand, we don't think is a sound fundamental thesis. It can be a thesis. It's more speculative. We feel that we need to see earnings growth and evidence of earnings growth to drive equities higher rather than simply expect the forward PE to go from over 18 right now to 19 or 20. It certainly can. We haven't had that late cycle kind of exuberance blow off of equities.
You think that there are quantifiable impacts on earnings per share based on the tariffs?
Oh, absolutely.
Really?
Yeah.
on the big multinationals?
Oh, you look at what corporations have. You just listen to the CFO and CEO comments for the last 12 to 18 months.
They like weather too.
Look at CEO confidence. Look at.
You think there'd be more investment?
More exactly.
Really?
The U.S. economy has been driven by the consumer over the last 12 months.
Right.
CapEx has been sliding. It's been in certain industries. It's been down. You take away that uncertainty, you would have seen greater investment. You would have seen better outcomes. Certainly, the U.S. economy is in a pretty good space when you look at consumers, unemployment, consumer spending. In 2020, we need to see some handoff from the consumer, from central banks to fiscal policy in Europe to business investment, or else the risks of recession increase.